This is episode 5 of the Bitcoin price report for October 25th, where we discuss the macro, the micro, fundamentals, and technical analysis with a focus on the Bitcoin price. Welcome to Eclipse Week, and let's see if the next couple weeks bring any chaos. Today, Bitcoin was at 19,302 in the morning, down 1.3% last week. However, Bitcoin went up in the evening to 20,118. We're still consolidating around the very firm support level at around 18,550. The CBBI.info index is at 7, still in the undervalued range. Recent news shows that Bitcoin's correlation with gold has increased, which bodes well for the thesis that Bitcoin is a safe haven asset. We did add a small Bitcoin position in our dollar cost average and limit order strategy portfolio, 0.05319 Bitcoin at a price of 18,800. It's actually triggered October 12th. Our portfolio is down 0.2% from inception. Let's move on to the technicals of the markets. The S&P 500 has rebounded above support levels of 3650 with resistance around 3936. The weekly MACD is pointing up. The Nasdaq QQQ is above support levels of 11,030 with resistance at 12,118, and its weekly MACD is pointing up. The 10-year yield fell to 4.09% after peaking at 4.34%. The MACD increases are decelerating. Gold seems to be consolidating below the resistance at 1680. The weekly MACD is flattening. Oil is below the resistance of 92.95, right now at 84.92. The MACD is also flat. The dollar remains flat, and the MACD is turning down. The pound has rebounded and is still near resistance of 114. Rishi Sunak became the new UK Prime Minister. The euro continues to bounce from support with the MACD turning up. The yen is flat around 148 yen to the dollar despite BOJ intervention. In significant news, the BOJ was unable to keep 10-year rates under 0.25% with their bond buying program and yield curve control policy. Yield curve control is when the central bank buys bonds to try to keep their longer-term bond rates below a certain interest rate. On to some macro analysis. The big question still remains, are we heading towards a recession? Robin Brooks, former chief FX strategist from Goldman Sachs, warns a global recession is coming, with Germany, UK, US, France, and Japan showing exports decreasing significantly. Not only that, Bloomberg called a 100% recession forecast within 1 year, using 13 macro and financial indicators. The US Conference Board leading index went negative, and as Macro Alf suggests, that if it stays below zero for a couple months, we're in a recession. The 10-year yield minus 3 months finally inverted, and that's an indicator we mentioned before as a great leading indicator of a recession. The ECRI weekly leading index indicator is pointing down. So how low can we go in a recession? The average drawdown for the S&P 500 during a recession is 35%. The average low on the PE ratio is 11.9. If we estimate the average 18% earnings drawdown from the peak of 249.5 earnings per share, multiply that by the average low of 11.9 in terms of the PE ratio, we can estimate an average recession could take the S&P 500 down to 2434. And this is an average recession, so we have a long way to go. The big question is, this rally seems to be starting strong with technical indicators improving and seasonality favorable, especially coming into elections. Can we have a really big rally before we hit the recession? Sure, but it's very unlikely to be a big rally, and it may be more likely we have weaker rallies going forward as recessionary pressures increase and with continued currency and sovereign debt issues persisting. Furthermore, if we look at history, when the bear market momentum begins, it seems to follow through into the recessionary periods with very few occurrences of rebounds that get near all-time highs. 2001 in this chart is a more likely scenario where the bear market just continues into and through the recessionary period. Mr. Blonde has a good chart of showing S&P 500 drawdowns from the beginning of official recessions. While there seem to be some significant rallies in the year leading up to the recession, the magnitude of the recessionary downturn far outweighs the size of these rallies. So it seems better to wait things out, even take some short positions if the rallies are very strong, especially if these recession indicators continue. That's all for this week. Please like and subscribe, and see you next week.